When it comes to trading options, most of us are taught to do one thing: predict the future. But what if the real edge isn't about being a fortune teller at all? Today, we're diving into a professional mindset that flips that idea on its head. It's not about guessing what will happen, but about pricing the entire menu of what could happen. If you've ever traded options, you've been here, right? Staring at the screen, asking yourself these exact questions. This feels like the most important decision you can make, choosing the structure, your weapon of choice. But what if I told you that's the wrong place to start? What if all that time spent agonizing over straddles versus strangles is just a distraction from where the real opportunity is? That's the big idea we're unpacking today. All right, so here's our game plan. We're going to start by tearing down the wrong question that so many of us ask. Then we'll expose the illusion of implied volatility. After that, we'll get into the pro-level concept of global variance, show you how to actually put it to work, and finally, wrap it all up into a powerful new trading mindset. So let's get right into it. Why is focusing on the structure of your trade right off the bat a total trap? Well, it feels productive, doesn't it? Like you're making a critical decision. But you can debate strikes all day long and completely miss the single most important question you should be asking. This is the whole ball game right here. Professionals start with this question. They're not asking, should I buy a straddle? They're asking, is the market overpricing or underpricing the total potential for movement right now? We call that potential variance. It's a fundamental shift from worrying about tactics to analyzing price. Okay, so to really get a handle on variance, we first have to tackle this huge myth that trips up almost everyone, and that's the illusion of implied volatility, or IV. We're all taught that IV is like a fear gauge, right? That if IV is 25%, the market expects a 25% move. But that's not really what's going on. In reality, IV is just a plug. It's the number you have to jam into a pricing formula, like Black-Scholes, to make the formula's answer match the option's real price on the screen. It's an output of a model, not a direct prediction from the market. The source material we're looking at puts this perfectly. IV is a convenience variable. It's just shorthand. It's a way for us to talk about an option's price in terms of volatility, but it isn't some pure forecast cooked up by the market. And here's the real kicker with IV. It's a local measurement. Think of it like looking at one single building in a huge city skyline. It only tells you about one strike at a time. If IV were a true forecast, every single option for the same expiration date would have the same IV, but they never do they? The fact that we have things like volatility skews and smiles is proof that the market is pricing a whole range of outcomes, something a single IV number just can't capture. So if IV is just looking at one building, how do the pros see the whole skyline? Well, that's where this idea of global variance comes in. This is the metric that captures the whole picture, the entire distribution of what could happen. So let's be super clear on what we mean. Local volatility, that's our IV. It's your risk at one specific point on the map. It answers the question, what's the risk right here at this strike? Global variance, on the other hand, is the whole map. It combines all those different points to answer a much bigger question. What is the market's total aggregate expectation of movement across all the possible outcomes? It's a view of the entire weather system, not just one street corner. And guess what? You're already familiar with the famous measure of global variance, the VIX. The VIX isn't just based on some at-the-money option, no way. It's actually calculated by taking a whole strip of out-of-the-money puts and calls and mashing their implied variances together into one number. For our purposes, you can think of the VIX as the price of a 30-day variance swap. And this explains something that probably confuses a lot of traders. You ever notice how the VIX is often higher than the implied volatility of the at-the-money straddle? Well, it's because the VIX is including the price of all those out-of-the-money puts that people are buying for crash protection. That fear of a big drop, that skew, pulls the total implied variance higher, giving you a much more complete picture of the risk that's actually priced into the market. Okay, so this is all great in theory, but let's be real. Most of us can't just go out and trade an institutional variance swap. So the big question is, how do we take this professional concept and actually apply it in a regular trading account? Well, the default answer for getting volatility exposure, the classic play, is the at-the-money straddle. You buy a call and a put at the same strike, and you're just betting on a big move. Simple enough, right? Well, here's the problem. A straddle is honestly a pretty terrible proxy for global variance. For one, it's a local object. It's tied to just one strike. The second the price moves away from that strike, its sensitivity to volatility, its vega, and its sensitivity to price movement, its gamma, they just crater. This makes your P&L totally dependent on how the market moves, not just how much it moves. A true variance trade doesn't care about the path. So here's a much smarter way to approximate that global exposure. Instead of one straddle, the pro approach often uses two strangles. First, you anchor your position with a mid-delta strangle. Think options with about a 25 to 30% chance of finishing in the money. Then, you add a second, wider strangle with a lower delta, maybe around 10 to 20%, to capture those really big moves. So why does this two-strangle thing work so much better? Well, first, it spreads your bet across multiple strikes. Your sensitivity to volatility doesn't just fall off a cliff like with a straddle. And second, by buying options out in the wings, you're naturally tapping into the skew, which is where the market often prices the most uncertainty. This structure just does a much better job of capturing the true shape of the market's priced-in variance. And look, all of this, it brings us to the final and really the most important point of this whole explainer. This isn't just about learning a new tactic. It's about adopting a completely different way of seeing the market. This quote just nails it. The real shift, the thing that separates the pros from the rest, isn't about finding the perfect structure. It's about starting with the right question in the first place. Is the price for all possible futures cheap or expensive? When you make that shift, you stop trading your opinion on where a stock is headed. You stop guessing. Instead, you start trading the entire distribution of possibilities. You are analyzing whether the price of uncertainty itself is a good deal. That, right there, is the game changer. So, we'll leave you with this. The next time you pull up an option chain, just pause and ask yourself, am I trying to trade my opinion of what's going to happen, or am I trying to trade the market's pricing of everything that could happen? The answer might just change everything for you